Hey there, Stu.
Hey, Danny, how you doing?
Good.
I'm glad to hear that. You didn't have to dress up for me.
See, I'll start letting everybody in here.
I have an agenda. They have a way to ask questions.
Yep, they can type it in the chat or just raise their hand in person.
Okay.
Get everybody in. Looks like everybody's coming in.
That's all right. I'm okay with it. I'm just wondering if
Migrate this over. Yeah, it just doesn't work. I never look like I'm looking at the people I'm talking to because
you're always looking at your screen. Yeah, I'm the same way.
Yeah, the room just doesn't lend itself to that. At the office, it looks really cool. I've got my certificates behind me and everything, but at home, not so much.
Yeah, it's a little different now.
Yeah.
All right, so it's 12 o'clock, and it looks like people are sort of still trickling in, so we'll have a few more coming in. But I want to introduce one of our preferred vendors, Stu Levy. He's a CPA and tax planner. He's here in the South Bay area in Torrance also, and also a member of our Rotary Club. So he has all the tax advice and information that we can ask him. We'll have him go through his spiel on the tax stuff, and then we can ask questions after. So feel free to throw them in the chat if you have them, or raise your hand in the videos. It's all yours, Stu.
Thanks very much, Danny. So there's not a lot new when we're looking at preparing our 2020 tax returns, but there's a lot of stuff that's out there. I'm sure we've all heard about the stimulus payments. Some came in last April, some came in January. There's talk of a third one coming sometime this year. A lot of people didn't get their preliminary stimulus payments either because they didn't file a 2018 tax return, or they filed a 2018 tax return but they were dependent. Don't worry about that. When you file your 2020 tax return, if you were eligible and didn't get a stimulus payment, you can indicate that you didn't get it, and it adds on as a credit in your 2020 tax return. For the 2021 credit that's going to come after the government decides to give it, that will be a refundable credit on your 2021 tax return. But in the meantime, there's money out there if you missed it this year. For people who have businesses, the PPP2 second round is coming out. There was a lot of concern about forgiveness of the original PPP loans. You don't have to worry about filing that forgiveness yet. If you have 10 months from the end of your period, which is usually 24 weeks after you got the money. Most people got the money sometime in May or June, and so you got 10 months after that to get your application in. So you got 24 weeks after you got the money and 10 months after that to apply for forgiveness. And it seems that every time Congress gets together, they come up with better answers for the people who receive the loans. So we're suggesting that people not rush to submit their application for forgiveness. You people are in real estate. There are a couple of real estate things that are on the table right now. Prop 19 is the biggest thing. And there's a couple of key points with Prop 19. Basically, the rule with Prop 19 is only relates to family residences. If you have a bunch of rental properties and you die, your heirs are going to have step up in basis in the property taxes. And so if you bought a property for $200,000 and it's worth $1 million when you die, your heirs are going to pay property taxes based on the $1 million. The key thing is the Well, there's a couple of other things in there, but the key thing is principal residences. That's the one that I think that people are most worried about. And for the principal residences, if your heirs are going to use it as a principal residence, they can keep your property tax basis. If they are not, then the property tax basis is going to step up. With all of these properties, the question that comes up currently is, should we gift our property to our kids so they can keep our lower tax basis before, and we gift the property before the February 15th date? And there's two things to consider with that. If you gift it to them now, when you die, there's a step up in basis. They won't get that because they will already have the property, and they'll have your income tax basis, not your property tax basis. There is some concern that, and there is always some concern that they're going to take away the step up in basis rules. Um, I personally can't imagine the Congress is going to do that, but there's a lot of things Congress does that I can't imagine that they would do. So there's some real important stuff to consider before you just blatantly go out and gift the property to your children. There are, let's see, Senate Bill 91 is out there. That's something that's supposed to provide some relief to uh, landlords. There's some money out there for landlords to get from their tenants, or not from their tenants, from the government for their tenants. That's something that it's not passed yet, so we have to worry about that in the future. But that's something that's really can be a help to landlords. Two other things I wanted to make sure I covered. When you are, we all know that starting in, I want to say 1980 something, meal expenses, well, starting in 2018, you could no longer deduct entertainment expenses, and you were still limited to the 50% of the meal expenses that you had from the 1980 laws that passed. For 2021 and 2022 at this point, 100% of meal expenses are deductible if the meal was gotten from a restaurant. And there's an important consideration there. If you go to the bagel factory on Hawthorne Boulevard and buy bagels for your staff, that is 50% deductible because that is not a restaurant. But if you get takeout from D. Roma's down the block, then that's a restaurant, and that's 100% deductible. So that's something that's important there. And the other thing that I wanted to cover, and I hear a lot of people are talking about leaving the state because of a various number of reasons. I won't go into them, but California doesn't really want people to leave, because what a lot of people are doing is they're not really leaving the state. They're buying a property in Nevada or Texas or Wyoming, and they're changing their residence to that state, but they're really not. California really gets pissed off at that. And so what they're doing, they've always had this program, but they're being a little more aggressive about it now, is they are auditing the people who take that position. And the audits are really, they can be intrusive. They will look at where you get your haircut, where you go to the doctor. They'll look at your credit card bills is basically the answer to the question. And they want to know where you spent your money. And if you spent your money more often in California than you spent it in your resident state, then you're not a resident, you're not a non-resident of California, and they're going to tax all of your income in California. Your real estate in California will always be taxed in California no matter where you live, just like your real estate in Indiana is taxed in Indiana no matter where you live. But if you're the bulk of your income, your earnings, your pensions, because a lot of people leave the state when they retire, your investment income, dividends, interest, capital gains, those are taxed to your resident state. And if you move to Texas, there's no income tax in Texas. But if California pulls you back, those things will be taxed in California. And those are the highlights. Does anybody have any questions?
I think, I guess the bigger one probably is on the stimulus check. So since everybody got those, is that taxable income that we have to claim?
That is not taxable income. The stimulus checks were an advance credit on your 2020 taxes. So if you got the stimulus check, so there's two questions, I guess, on the stimulus checks. Are they taxable? And what if I didn't get them? So if you got your $1,200 or $2,400 in April, and then you got your $600 or $1,200 in January of this year, those aren't taxable. But if you didn't get them, when you file your 2020 tax return, you indicate that you didn't get them, and they become a credit on your 2020 tax return.
Okay, so if you didn't get either a check or the debit card or whatever payment,
no, they're just gonna, it'll just be part of the tax you paid. And so I've already prepared, although we can't file tax returns until February 12th, but I prepared a number of the tax returns already. And what's happened is, for those people who didn't get that money, it's treated like additional withholding. So if you were due to get a refund, you'll get a bigger refund. If you were due to owe money, you'll owe less money. But
Okay,
the stimulus
that makes
checks are
sense.
absolutely not taxable.
Mhm.
Hey,
Carol?
Carol, you have a question?
Okay, I have a friend who's a real estate broker. She does not own any property in California, and she just bought property out of state. So are you saying because she'll be doing business in California, that the state will think that she's still a resident here, even though she doesn't own anything?
Well, if she doesn't own anything in California, there's something called Nexus, and Nexus is what ties you to a state. And so what happens is, excuse me, I have to make this phone call go away. So if you have, so so this person never a resident of California?
She's been a resident for years and years and years and years and
So
years.
she's a resident of California.
She's a resident of California, but she's actually going to be living out of state. She has a business here in California, so she'll be going back and forth because of the business, but she won't, and she's going to be renting short-term rental while she's here, or a hotel or something. So is it
what
linked
she
to
has
the
to do-
fact that you have a home or had a home?
So what she has to do, first of all, the income from the business is always going to be taxed to California because the business is in California.
Probably so, yeah, okay.
And so that's black and white. But if she's moved out of state and she's registered to vote, registered her car, got a driver's license, done all the stuff that proves that she's a resident of that state, that used to always be the thing that we said made you not a resident. But now, if she's going to spend a lot of time here, if she's going to, and I'm going to say, it's in your friend's case, it doesn't sound like it's going to be an issue. But if she's going to go to the doctor in California, if she's
Got it.
going to, she has a dog and she wants to take it to a vet and she only brings it to a vet in California. If she
Right.
has all the things that says, I'm really a California resident, they are going to say she's a California resident. It doesn't sound like that's going to be an issue for her.
Got it. Okay,
The
just
business will be taxed in California, and to the extent that it's a distributive business. So if, let's say, it's an S corporation, and she's going to get or a partnership, and she's going to get a K1, that K1 is going to pay California taxes, but the rest of her income won't pay California taxes.
got it. Okay, thanks, Stu. Very good.
My pleasure.
And I'm guessing, I don't know if anybody on here, but back when they announced all of the PPE loans, and since a lot of us are independent contractors, some of us may have applied. I wasn't able to, but you can, I guess, request anywhere between, I guess, would be $10,000 to $30,000. So I'm guessing that would be taxable income then.
Well, technically, actually, there's a whole bunch of stuff going on with the PPP loans. PPP loans are, first of all, it's almost impossible not to get them forgiven if you use them correctly. I got a PPP loan, covered payroll, covered rent. Mine is going to be forgiven with no question. I have a client that's a big retailer in the area, got like $500,000 in the PPP loans. Again, spent all of his money on payroll, spent all of his money on rent. So he is going to be completely forgiven. However, for both federal, the SBA loan is going to be forgiven. When you're forgiven a loan, it's income. The federal government has said that is not going to be taxable income. California has agreed with that and said that is not going to be taxable income. However, The original law said it's not going to be taxable income, but you can't deduct the expenses you paid with that money. So in the case of my client that got $500,000, he got $500,000. He spent the $500,000 on payroll. When he files his tax return to show that his $500,000 has been forgiven, he also can't deduct the $500,000 of payroll expenses. The bill that passed in December said, no, you can deduct those expenses even though the income is going to be not taxable. So in this case, he's going to have $500,000 of not taxable income, and he's going to have $500,000 of deductible expenses. But California has not gotten there yet. We're still working on California, trying to get them to convince that those expenses should be deductible. So what's going to happen to my client in that case is he'll have $500,000 of not taxed income, and he'll have $500,000 of expenses on his federal return. On his California return, he'll have $500,000 of untaxed income, and he'll have $500,000 of not deductible expenses. So now suddenly that makes, in his case, $500,000 difference in the in his taxable income between federal and California. And that's, again, another reason why we're telling people not to rush for the forgiveness, because as soon as you get forgiveness, new rules don't apply to you. So, for example, a lot of restaurants got PPP loans, and they spend some of it on payroll, some of it on rent, but some of it on buying PPE equipment, sorry, all those plexiglass things. And the expense on that was not included in the forgivable amount on the original loan, on the original legislation. But since then, they've changed the rules, and now that is forgivable. However, if you applied for forgiveness already, and you can't go back and say, well, now you'll forgive it, you already can't, it's already not forgiven, so you owe the loan not back on that. So
if they bought like the protective equipment, they can't write that off as really a business expense because it's already being given to them free through the loan forgiveness.
No,
thing, right?
actually, it's the other way. If you spent that, so if they gave you, let's say they gave you a $30,000 loan, and you spent, let's say you spent the whole $30,000 on protective equipment. You didn't, and that wouldn't be right, but let's say that was the case. You apply for forgiveness, and they say, we can't forgive this because you didn't spend it on what we told you you had to spend it on. You had to spend it on payroll, rent, utilities. That was basically all you could spend it on. And so they applied for forgiveness, and they said that $30,000 is not forgivable. Since then, they've come out with a law that said that $30,000 is forgivable. Well, if you already applied for forgiveness, you can't reapply. That $30,000 is payable back. And if you didn't apply for forgiveness yet, now that $30,000 fits in there, and you'll be able to have that forgiven as well.
Okay, that makes sense.
It's confusing.
For like for the independent contractor, I guess because we're real estate. So if they didn't have a building to write off, essentially, because they're obviously working from home during at least the 6 or 8 months out of last year for it, does that affect their write-off when they do like their personal taxes? I know you can write off like a percentage of your square footage or whatever you use as your home office.
So that won't affect you. You'll still be able to take a home office deduction. Interestingly enough, though, with a PPP loan, utilities are allowed. And so cell phones are utilities. And so to the extent that you can apply to say that I got this much as a PPP loan and this much I spent on my phone, that's forgivable. But basically, Danny, the way things are written right now, if you're a sole proprietor and your loan, certainly if your loan was under $50,000, the whole thing is going to be forgiven.
Okay.
Pretty much with anybody under $50,000, but it's going to be really hard to find a sole proprietor that's not going to have their loan forgiven, and they're not going to have any tax consequences from it. You'll still be able to write
that I've heard, they've all got small loans, between 5 to 15,000. I've just heard of the big corporations, which obviously have a whole finance team. They're the ones that got the $500,000 or more.
Yep. You've heard of Shake Shack, I think, got millions of dollars. So
or our MLS, the California Regional MLS, they got $500,000 also.
I just heard on the news this morning that the California Archdiocese got a whole lot of money too. Everybody's a little upset about all this stuff. But you can't, it's the rules, and this is who can apply. And if you use the money for the right thing, we're gonna forgive it. The archdiocese obviously doesn't have a tax issue, but it's the loan forgiveness issue. And so if you don't get the loan forgiven, the interest rate's like 1%, and you don't start having to make payments for many months to come yet. But so it's a good loan. But if you can get it forgiven, then it's free money. And the Congress has basically said this was intended to be free money. We just have to get California to agree that it was intended to be free money. Because right now in California, you lose the deduction and it's not free money.
All right, does anybody have any other tax questions for Stu? Trying to think of other ones that have popped up. So I know we have, what about for rental income? I guess that's probably one, since we have that SB 91 coming and a lot of those payments are getting deferred. What happens
Right.
if I collect all my rent money in 2022 rather than 2020 and 2021?
So your rental income is probably on a cash basis, which means it's income when it's received, just like your expenses are expenses when they're paid. So you're going to have a bad year in 2020, and you're going to have a bad year in 2021. In 2022, you're going to have a great year. Depending upon what the rest of your income looks like, there are provisions for net operating loss carrybacks. So if your only source of income is your rental property and you wind up with big losses in 2020 and 2021 because of people not paying the rent, it used to be you could carry your loss back 3 years. Now you can carry your loss back 5 years. So if you have a big loss in 2020, you can carry your loss back. You can amend your 2016 tax return and carry that loss back and reduce your income that year and get a refund for that year. So there are some provisions in there that let you do that for all businesses, but rentals, that's certainly an option.
So pretty much you're going to be doing tax returns for multiple years over and over again.
Yes.
Sounds like job security for CPAs.
It's job security that we really don't want. That's not the fun part. But the fun part is saying, well, you're going to have all this income in 2022. How do we prepare you for it, and how do we cushion you from it?
Yeah, that's the tough part.
I see a question that came in here. I don't know if you saw it about Prop 19.
For the Prop 19.
So the difference between the property tax basis and income tax basis is usually a pretty big difference. Your property tax basis is the number on which they charge you the 1.25% property taxes. Your income tax basis is what you compare it to to the sale price. So if I bought a house, and the example I usually give, I bought a house for $200,000. Now it's worth $2 million. If I sell it the day before I die, I pay tax on $1.8 million. If my heirs sell it the day after I die, they pay no tax because the basis stepped up to the $2 million, and $2 million sale price minus $2 million basis, there's no tax. Property tax used to be that the property tax went with the property tax basis if it was inherited. So if I bought the property for $2 million, I would have to pay property tax based on $2 million. But up until Prop 19, if I inherited the property, my property tax basis would remain the $200,000. Prop 19 says, unless it's my primary residence, now my property tax basis is going to step up to the $2 million. And there's some question, by the way, as to how they're going to calculate that $2 million. I think they're only going to, and this is probably where it was written by people who are wealthy, they're only going to consider the increase in property taxes on the first million. So in theory, if the property tax, if my property tax basis was 200 and it was worth 1.2 million when I died, it sounds like the property tax basis is going to step up to 1.2 million. But if it was worth 2 million when I died, it sounds like it might also step up to 1.2 million, because it sounds like, and again, until we see it, we won't know. But it sounds like they're going to use the step up on the first million.
And I guess the other thing most people are so on the inheritance when they have to own or occupy it essentially, is that for, like I said, like 3 months, 6 months, or just show the proof that they're living there?
So I think it sounds like they want it to always be your home, and I don't know how they're going to track it back. So if I inherit a property and I move in and make it my permanent residence, and nothing is permanent, if I in a year decide to change it to a rental property, how will they know? I don't know. However, I think there's something in place now. So and this sounds a stray from that, but I don't think it is. If you do a 1031 exchange and you sell a property in California and you buy a property, say in Texas or any other state, and let's say you deferred $1 million of income on the sale of that property, you have to, when you file your tax return every year, submit an affidavit to California that says you haven't sold that property. And so if you're submitting an affidavit that says you haven't sold that property, that's so California can say, California can say, we still don't get the money on that $1 million. If you then in a future year sell that property and your gain is $1.5 million, say, California gets the tax on $1 million because that's what was deferred in California. However, on the good side, and I know this is going really far down a rabbit hole, if you sell it and you only have a gain of $800,000, California only gets taxed on $800,000. They don't go back up to the million. The reason I bring that up is because there could be a thing, and this is the counties are going to have to do it, and I don't know that they're coordinated enough, but the counties they could request an affidavit that says this is still my primary residence. But I don't know that that's going to happen. I don't know that that's in their plan. I don't know what they're doing.
All right, I'm guessing too, like same thing on, obviously it's easy to prove if they're 55 years and older since we have that information, but like on the loss of a home, through like a natural disaster or disabilities, I'm guessing that's just up to whatever they put into law, because it seems very vague.
So it is very vague, but if your house burnt down, you can probably prove that your house burned down. You probably have an insurance document that says your house burnt down. And there is, by the way, no limit on how many houses can burn down. You can, I had a seminar the other day. The guy said, if your house keeps burning down, maybe you should build in a different area. But there's no limitation on how many times you can rebuy for a house that burnt down. There is a limitation on how many times you can move if you're over 55. And
yeah, so that one's transferred to 3 times. So yeah. I'm guessing that's going to be recorded with the tax assessor, I guess.
So yes, but if you move counties, that's going to be another issue.
Yeah. So how are they going to track that?
So we're all familiar at this point with Section 121 of the Internal Revenue Code that says you get a $250,000 income exclusion on the sale of a personal residence. And if you're a married couple, you get 500,000, 250 each. Before that came into play, there was a rule that said if you were over 55, you had a once in a lifetime $155,000 exclusion of income on the sale of a personal residence. And the question was, who's keeping track of that? And I don't think anybody ever kept track of that. I think everybody over 55 that sold their personal residence was able to claim, but it was a once in a lifetime exclusion, and that was the difference. Because if you excluded it once, then it's relatively easy for the government to go back and figure it out. But when we're talking about counties having to do things, I don't know that the counties have A, the facilities to do as much work as needs to get done, and B, to communicate with each other. If I sell my house in Los Angeles County and I move to Orange County, and then I sell that house and move to Riverside County, and then I sell that house and move to San Francisco, and then sell that house and move to San Diego, how are those counties all going to coordinate and know that I've done all that? So I don't know. I guess they could say, well, you originally had a house in Los Angeles, and we see you're moving from San Francisco, so you moved at least once. I just, I
You
can't
could also
imagine.
be renting, right? Too. I mean,
I can't imagine that the counties have that kind of facilities, and certainly as well as the Employment Development Department has been doing, you can't imagine that the counties can do better than that.
I think
That was a slight at the Employment Development
I've learned
Department.
a lot about Prop 19. So, anybody else have any questions? Either personal tax returns, business tax returns. I think we covered the forgivable loans. I guess any kind of unemployment would just be same thing. You would use whatever the EDD return is, right?
So this actually, and that actually brings up something about the EDD. I didn't mean to do it, but so there's been a lot of people who will get a 1099 from the EDD that says they got this much money in unemployment benefits, but because of the incompetence of the EDD, maybe did not get that money. There's something called constructive receipt. And what constructive receipt says, if I didn't get the money, I don't have to pay tax on it. There has to be some kind of disclosure on your tax return, because the IRS is going to say you got a 1099-G that says that you received $10,000 in unemployment insurance, but maybe you only received $3,000 of it. So you're going to have to do some, you're going to have to make some disclosure on your tax return to show that you didn't actually get that money.
So there either be copies of the checks or I guess bank statements just to show.
Well,
that
on the
this is
tax
all that was
return,
deposited.
on the tax return itself, you just have to say, I didn't get that much money.
But they should have
is,
proof though of all the
what
deposits.
what kind of underlying support do you have? And bank statements are usually the way to go. Although because the unemployment is coming in debit cards, I don't know how you would
even harder.
It is very hard. When you get audited, the auditors do something called a bank deposit analysis, in which they look at all of your bank statements and they look at all of the deposits and they reconcile it. So let's say I get a W-2, and my net W-2 after I subtract my taxes and everything comes to $95,000. And so the IRS looks at my bank statements and they say, well, gee, you had deposits of $115,000. Explain the $10,000 difference. And that's how audits work. And if you have a good answer, I got a gift, I got an inheritance, I won the lottery. $10,000 seems to be hardly worth it to win the lottery. But wherever you can explain that $10,000, that's how it works. I don't know how you're going to be able to do that with the EDD unless you can prove. And again, this goes down. You're going down the road a year and a half, 2.5 years to when you're getting audited. But I don't know how you'd be able to show other than, dear EDD, again, I didn't get my check. And I actually spoke to somebody the other day who was receiving unemployment checks or unemployment debit cards, but never cashed them because he got a job almost immediately, but the EDD was unable to take him off their rolls. So because of that, he's been receiving this income, and he's going to get a 1099-G from California that says he got a lot of money in unemployment that he didn't get, and he still has the debit card that's unused. So we're going to have to report that as, again, unreceived income, income not constructively received, and we'll have to be prepared with all of his documents should he get audited. And the other thing about unemployment, and as an aside, so your regular California unemployment, you were able to have withholding on, because unemployment is taxable to the federal government, but it's not taxable to the state. So you're able to have withholding on your unemployment for federal taxes, but the $600 extra, the PUA benefits, I think it was called, you could not have withholding on that. So any plan that you had of having your taxes withheld, it didn't work. So you're going to wind up owing money potentially on that money you received for unemployment.
Does anybody else have any other questions? I put in the chat Stu's information there, so you guys can call him anytime at his office or email him the Stu at stuartleveycpas.com. Anybody else have any questions?
I'm happy I can be reached. Sometimes my phone system is giving us a hard time, but anytime you need me, feel free to give me a call, send me an email, and I'm happy to answer.
All right. Well, thanks, Stu. I'm sure people will be calling you as they get their 1099s and their W-2s. So thanks for doing this
Thanks
for
very
us.
much, Danny. Thanks for the invitation. Thanks for putting up with me, guys.
Yep. See you, Stu.
Bye-bye.